from around the world that the US markets are going into recession, and then entire Europe market is suffering, and they've got major energy crisis, all that. On the other hand, we saw IMF giving their estimates. We saw India continues to be the fastest growing economy in the world. But then it cannot be looked at on isolation basis, obviously, because we have a correlation with these developed economies as well. So as a portfolio manager, what's your take on this? Where do you think we are headed as an economy?
Right. Definitely, there are some worry signs in the market at this point of time. People are cautious, investor community are cautious, even the foreign investor for that matter, they are also going cautious on the market at this point of time. One thing that initially that you told that people are fearing about recession. If you look at all the data points right now, recession is where things prices starts going down. We are still getting all the data points which are on the inflationary side. All the numbers which are coming out right now from the US market, Europe market, they are facing the heat of inflation. From a journey from an inflation to a recession, it's a long process, definitely. Right now, all the measures what central bankers are taking, they are just trying to see to it that how the inflation could come under control, because they are seeing a decent amount of demand coming. No doubt the inflationary pressures in the market, that the global market was more of a supply side issue because of the supply of energy, the energy crisis that you rightly pointed out, which is affecting the European market. So no doubt energy and food, these are the two segments where the inflationary challenges are coming in this particular market. Apart from that, apart from energy and food, rest all other core items have already started to come down. The very recent Fed committee meeting which was announced, they have also told that yes, certain amount of challenges with respect to inflations have started to come down, but yes, energy and food, these are the two main areas that we need a concern with. We are concerned for the same. So right now, as a first step, what we believe, maybe just because of a base effect, maybe 2 months down the line, you will see a different picture. The entire inflation prices, the prices which have started to rise into the market, be it oil prices, metal prices, the supply logistic issue which was there, the freight charges, the globally which was moving on a higher side, those were the cause of concern. Freight charges have corrected, metal prices have corrected. In food items, some food have definitely corrected and they are trading low. Some items are still on a higher side. But if you look at the prices of oil and food which were 1 year back and the prices after 2 months down the line, if we are remaining at the same level as of today also, automatically the base effect will start pushing the inflation on a lower side. And that is the reason people know that yes, within next 2 months, 3 months down the line, whatever the numbers of the inflation that you are seeing, that will automatically start coming down. But yes, are we happy with that kind of an inflation? The answer from a developed market would be no, because whatever rise that has happened, it has created a damage. And because of that rise on the prices, although in base effect might reduce the inflation percentage, but the prices has increased. So that is a cause of concern. And interest rates which are moving on a higher side, that is definitely creating I can say discomfort for equity market right now, because there is always, I can say, a risk arbitrage between asset classes. So when debt markets are giving you a better return, certain amount of money definitely flows out from equity market. So last 8 to 9 months, what we have seen, whatever selling that has been happening from an FI perspective, there were two reasons to it. One, yes, interest rates rising globally, so that was the money was shifting from equity to debt. And also from an emerging market perspective, China is not doing pretty well. So any investor who has put money into an emerging market, definitely in emerging market, China has a bigger percentage allocation, that is more than 30%. So if they want to move out from emerging market, pressure is there on China also, but even some pressure is there on Indian market also. So we have seen the flow of money moving out from Indian markets too at this point of time. Looking at Indian macro right now, world market, we know the challenge, what is happening in the world. We come back to the India.
So I want to talk about what is the domestic story.
Right. So if you look at the Indian market right now, 80% of the Indian GDP, I can say we are self-sufficient. 20% is our total export. Out of that total export, around 13% is a financial services, or I can say travel services related or IT service related, all those kind of exports that we are doing. 7% are merchandise exports that we are doing over here. So leaving apart that 20% segment, rest all 80% of the economy is self-sufficient. They are able to internally meet the demand and supply also. Post-COVID, what we are seeing, a tremendous amount of demand has started built up in the market. There was definitely pent-up demand also there, but lot of capex side of the activity has started by the private players, which was earlier missing. If you, because why I'm saying so, because if you technically look at the Indian market, we made a peak in GDP way back in 2018. 2018, March 2018, you check the GDP figure, which was inching more than 9%, and now subsequently from 2018 till date, our GDP growth rate was slowing down constantly.
Right.
During COVID crisis, we went into a negative trajectory. What government had did in the initial first 5-6 years, that is the Modi government from 2014-15, it created definitely lot of hope, because the government is more towards focusing more towards the growth of the economy, the vision also that they are carrying. But first 4-5 years went up in a cleanup exercise, I can say, making system more and more compliant, coming out with demonetization, coming out with GST, RERA. So all those measures initially dented to a certain extent the business sentiment, and post that, now what we are seeing, the gap which was created in terms of private consumption, the gross capital formation, that is the numbers that we look at now, that gross capital formation has started into the market in India. You can see all the order books outstanding of many of the cap goods, engineering oriented companies, that is just giving us a vision that next 2 to 3 years are really good for the market. But yes, one is the fundamental side of the story, that market for the next 2-3 years are really good. They are going to grow. As an investor, along with the fundamental, you also need to look at valuation. So this is the thing that is right now, I can say, halting in the market at this point of time, because we are not cheap. We did correct with the global market, but we again bounced back very sharply in last 1 year, because lot of support was there from a domestic investor. So we are getting more and more towards matured kind of an economy at this point of time. So domestic investors have lot of confidence and trust right now, because they are not facing that kind of a challenge which the global market is facing. The industry in India, the business setups are in India, they are not facing those kind of challenge. Even if you look at the IT numbers, the companies which have recently declared, the technology companies, be it TCS, Infosys, although we were thinking that there might be some subdued remarks that might be coming out from the management of these companies, but no one is till date talking about clear-cut recession. In fact, some of the IT companies has increased their revenue guidance also. So things in India are relatively different. What we are worried about is the valuation. We have not corrected, and the world market has corrected. So based on relative basis, yes, we have expensive compared to the developed market over here, but our growth rates are still going to be much better. If any investor across the globe, if they start thinking that yes, the interest rate cycle has peaked out, and if they now again come back into equity market, then India is definitely one of the most favored destination where the growth rate is also really good at this point of time. So I don't see any reason why one should not be coming into India, participating in the Indian equity market. It is just the time, I can say, maybe 3-4 months down the line, things would be completely different for Indian market.